There's a lot more uncertainty in all markets these days, and both the stock and real estate markets are pretty shaky. Rising inflation and borrowing costs combined with slower sales growth puts us in a possible stagflationary scenario, which isn't good for stocks. These factors are also not great for real estate investing either, since it's mostly fueled by mortgages. As costs and rates go up, net income gets compressed and holding power gets weaker. So if you're trying to figure out what's a better place to put your money, keep watching. In this video, I'll walk through how returns in stocks might compare to investing in real estate in Toronto in 2022. Before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you can see more videos like this made specifically for real estate investors in Toronto. I believe in investing in a diversified portfolio, so it's always a good idea to invest in a mix of stocks, real estate, crypto, and bonds. These markets don't always move in line with each other, so as a whole portfolio, you will see lower volatility when you have more varied assets in the mix. Having said that, the returns of different assets will be different and their risk profiles are also different. We have bonds that have the lowest returns and the lowest volatility, stocks that have higher returns but higher volatility, and then we also have things like crypto, which might have the potential for the highest returns but also has the highest volatility. In my mind, the class that kind of sticks out from this bunch is real estate because it actually has higher total returns compared to stocks, and yet it has lower volatility. Let's go all the way back to 1976. 45 years back in history. If we look at the annual returns of the S&P 500 index, you'll see that the average annual return has been around 10% per year. We can also look at how much prices fluctuate, and when we do this, you can see that the standard deviation in prices is around 16%. Now, let's look at Toronto real estate from 1976 all the way until today. Real estate is made up of appreciation and rental income. What you see is that appreciation on average has been around 7%, but its volatility is also significantly less than stocks. Then we need to also add in rental income. It turns out that on average, cap rates in Toronto freeholds have been around 9% over the past 45 years, but we've obviously seen this drop like a rock in the past 10 years, and right now it's compressed to around 3.8%. What's been happening is that before, real estate returns were more heavily weighed on rental income. But as Toronto continues to grow into a more global city, our city's price growth sped up drastically, outpacing inflation and rental price growth. And so appreciation now makes up a lot more of our Toronto real estate returns pie. Basically, the distribution of appreciation and rental income got shifted over the years, but as a whole, real estate returns don't vary too much. What we see is that the return fluctuations is still less than stocks, but the total returns are much better at 16%. So from a risk-adjusted return standpoint, Toronto real estate really sticks out as a superior investment class. Most real estate investors don't buy properties with straight cash, and you can get much better returns if you get a mortgage to invest in real estate. This is the concept of leverage, which I go through in another video right here. Using leverage is not a buy and hold strategy for many investment classes like stocks, but it makes a lot of sense for real estate. You get the best loan to value ratios with residential real estate, the lowest borrowing rates out there, and your rental income helps you pay for your monthly mortgage payments so you continue to have good holding power. The thing you need to know when you're using borrowed money to increase your returns is that you are magnifying your real estate returns. Gains get magnified, but losses also get magnified. In other words, your return swings a lot more, so your investment does become higher risk with leverage. If we dive into the numbers, with a 20% down payment, the average real estate returns gets magnified from 16% to 44% per year. The results are pretty drastic over a 10-year period. Assuming you have $300,000 to invest in, if you put that into the S&P 500 index at a return of 10% per year, At the end of 10 years, you would have gained $479,000, which is amazing. If you put the same amount of money into a Toronto freehold investment, getting 44% in annual returns per year based on a 20% down payment, this is a whopping $11 million in returns over 10 years, which is insane. Now, keep in mind that your risk with levered real estate with a 20% down payment is higher than just investing purely with cash in the S&P 500 index. Real estate returns after leverage here has a standard deviation of 38% compared to a standard deviation of 16% with stocks. Now, if you want to get a similar risk level closer to what you'd get with stocks, you would have to lower your leverage significantly, but yet your returns will still double what you would get with stocks. Besides leverage, another huge benefit for real estate is tax advantages. When you collect dividends from stocks, you will have to pay income taxes on it. With rental income, you have the ability to depreciate part of your building each year to lower your taxable income. In today's market, it's possible to have minimal taxable rental income because of this and defer a good chunk of your income tax until the time of sale. The second advantage for real estate is capital gains tax. Principal residences have the biggest advantage of not being subject to capital gains tax. But even for investment properties, you have the option to refinance your property to take cash out to reinvest instead of selling it. And so you are again able to defer capital gains tax until later down the road. What this means is that you're able to invest pre-tax funds, which will increase your total returns. Now, you probably agree that Toronto real estate is a great long-term investment, but given that interest rates are on the rise, does it make sense to buy an investment property today? In my personal view, real estate should always be a long-term investment, so I'm comfortable with using average appreciation rates in my returns projections. The factor that I'm more concerned about these days is holding power. Given that rent yields are still low and interest rates are rising, I would need to make sure that my real estate investments provide strong holding power in the short to medium term so that I can hang onto my real estate investment and reap those great long-term returns. Let's walk through this with a starter investment freehold that's priced at around $1.2 million on the market today with cap rates at 3.8%. If we assume overnight rates go to around 2.5% in a year's time, so variable rates go to around 3.5%, which is consensus so far, then our rental income will be lower at $12,000 per year. After we deduct depreciation, we'll have no taxable income and our monthly cash flow would be negative $550 per month. Of course, this is not ideal, but many of today's investors are comfortable with these amounts already since today's condo investments in Toronto are cash flowing negative at a similar amount with half of the purchase price. Let's see how much we'll get if we invest the same amount of money into stocks today. We're currently in a weaker economic situation and Goldman Sachs predicts 4% gains for its best case scenario in the S&P 500 index from today onwards. The worst case, a drop of 21% by year end. So even in its best case, that's equivalent to $11,000 worth of gains. So even if real estate investment returns come purely from rental income with no appreciation, then rental income alone will still beat stocks. We're in much more volatile times right now, so it's very possible to experience short-term negative returns no matter which market you get into at the moment. With real estate, I recommend entering with the mentality of buying and holding and making sure that you can withstand the negative cash flows if rates go up to 3.5% or even 4.5%. But note that in the long run, investing in Toronto real estate will generate better, more stable long-term returns compared to stocks. I don't like to speculate and I don't know where Toronto real estate prices will actually go, but I continue to be bullish in the Toronto low-rise market purely based on fundamentals. We know we have a housing crisis and the government is finally admitting to it after trying various tactics to curb demand. We also might be undercounting our demand numbers, which makes actual conditions even worse than what the numbers show right now. CIBC is saying that we're probably currently homes short because students who are renting somewhere else when they go to school are counted as living with parents on the census. Plus, the census might also be underestimating the number of homes needed for new immigrant fresh grads who most likely need their own housing, but is counted the same way as fresh grads who most likely can go back to their parents' home once they graduate. In Toronto specifically, our urban center benefits the most from the COVID recovery story as demand for housing in the core continues to rebound. Plus, our city has limited vacant land to build new homes. So, investing in land in Toronto will always be desirable. We're big believers in investing in freeholds in Toronto, and if you want to chat more about this, we're ready for you. We can take a look at your requirements and preferences and then match you up with the best investment property that fits your needs. After we help you buy it, our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.